Should you pay off your mortgage when you get to retirement? That's a great question, and it's rarely a bad idea to pay off debt, but it can be kind of tricky. So we're going to go over that and maybe cover some of the dominant themes that you want to consider. So by the end of this video, you'll have a solid understanding of the advantages and disadvantages, and we're going to go over a specific example with some numbers, including some tax numbers. So just to give you a quick preview, this isn't going to be an extravagant example of a huge debt. It's a pretty common debt amount, but it can make somebody jump from the 12% federal income tax bracket to the 24% federal income tax bracket, so that can affect your decision. So the advantages of paying off the debt are probably pretty obvious to you. You have no more monthly payment, and that is often one of your biggest expenses in retirement. Healthcare might be another one, but when you can get rid of that mortgage payment, it makes life a lot easier. So you also stop paying interest, and you might be paying at a relatively low rate, but still that's going to drain some of your resources and cost money. So if you can quit paying interest, that's often a good thing. And then of course you can reduce market risk. So you might say that you have a lot of money in a retirement account, and at retirement you're concerned about all of the ups and downs in the markets. But if you can put that money into your home mortgage, you can, again, stop paying interest, which is kind of like getting a guaranteed return. So if you're paying interest at 3 or 4%, that's similar to a guaranteed loss. But if you can stop paying that interest, you effectively get a guaranteed return of that much. So these are the reasons that a lot of people like to pay that off. And let's get into an example here. Let's assume you owe $150,000 on your home. You've got that much in an IRA or a 401k. Maybe it's your TSP or 403b, any of those retirement accounts. We'll say you and a spouse get a total of $36,000 of income. Now, if you are a single person, this isn't going to change the equation much at all. So we'll assume that you have the average Social Security income for an individual of about $18,000 per year. So it doesn't matter, single or coupled. Then we're going to say you're also taking withdrawals from a pre-tax account of $36,000 per year. So that gives you a total spending money of about $72,000 per year before taxes. And if we look at that situation, you'd be roughly in the 12% federal income tax bracket. You might be wondering, why is that so low? If we look at the amount you're going to pay in federal income taxes, it's roughly $2,700, and we need to remember that you're going to get a standard deduction. So in this case, we have the couple's standard deduction, and that not all of your Social Security income is taxable. So if you primarily have Social Security income and maybe a relatively low income based on withdrawals from your retirement accounts, you're probably not going to pay a huge amount in taxes, and that's the situation here. But if you do pay off the loan, it looks something like this. We've got your $36,000 of Social Security income, another $36,000 of IRA withdrawals, and then this big, huge chunk for the $150,000 withdrawal. So as you can see, that substantially increases your income. Now, with a smaller loan, maybe you have $8,000 left or something, and you say, I just want to get rid of it so that it's out of my hair and I don't need to worry about it. That's going to make much less of a difference. But if you do have this big loan like that, it's going to make a big difference. So in this case, we're looking at total income taxes, federal, that you would pay. We have not included state taxes here, of about $34,000. So that's going to be an increase of about $31,500 for that year. So that's a big difference. And what that means is that when you go to pay off the mortgage, you're not just going to pull out the $150,000 that's your loan balance. You're also going to have to pull out $35,000 or so on top of that so that you can cover those taxes. So this can make a substantial dent in your retirement savings. Plus, you're going to be writing a big check to the IRS or doing a big online transfer. Now the question comes up, of course you will pay taxes on that money eventually as you withdraw it, but if you're pulling it out slowly, if you're just dribbling it out, a couple thousand at a year or a couple thousand a month, it's going to probably be at a lower rate. So that can mean that you would pay substantially less over your lifetime, and you can keep that money in the tax deferred account to compound. So we've got some other issues that might come up. You might be paying higher Medicare premiums in a future year, and often that'll be just for a year in a situation like this, but you might have to pay more each month for your Medicare premiums. You might also increase the amount of Social Security income that's taxable to you, and that is included in that example we just looked at, by the way. Your Social Security income is more taxable, which increases the total federal income tax you pay. Then if you're under age 59 and a half, you might be paying penalty taxes. And we need to remember that when you're in the latest years of your loan, you might not be paying that much interest on your loan balance anyway, because as you pay down a loan balance with most standard amortizing loans, you're paying a lot of the interest up front in the early years of the loan. But as you get towards those later years, you have paid most of the interest charges, so most of each monthly payment on your mortgage goes towards paying down the loan balance. So it might not be costing you quite as much as you think. And a couple of other potential pitfalls might be, number one, access to those funds. So when you put it into the home, it can be very difficult to get that money back. You could potentially borrow against your home equity using a second mortgage of some sort or a reverse mortgage in retirement, but getting those types of loans can be expensive. It might require income if you're going to do a home equity loan, so it can take time and just make it difficult to get that money. There's also an issue of creditor protection, so your money is typically quite safe in retirement accounts. Your home is also typically quite safe, but there could be situations where your home is at risk, like if you're not paying taxes in particular, property taxes. So, you just have those questions that you want to at least raise and think about. And then you just have less money available to draw on because you have spent most of your retirement savings on paying down that debt. So if cash flow is going to be a potential issue, you want to look very closely at that decision before you move all that money into your home. A lot of people, when they approach this question, they just talk about the rate. So what about the rate? So as you are paying interest at a relatively low rate, the question always comes up, well, could you do better on your investments? And when you're in retirement, you might be more conservative, so you're not necessarily going to be investing aggressively. Whether or not that's going to be an issue, it's just hard to say because we can't predict the future, but you want to at least ask, what is the rate of interest I'm paying? And again, are your monthly payments going towards mostly interest or mostly principal? And is it possible to do a little bit better in the markets? And of course, you could lose money if you keep that money invested, so you need to acknowledge that as well. Once again, it's rarely a bad idea to pay off debt because you do get that guaranteed reduction in costs. You aren't going to have that money in the markets, but it's not always the best approach. So I hope that this has been a helpful discussion and gives you some ideas. If you want to do a detailed analysis of your loan and does it make sense to pay that off, please let me know. Would be happy to do something like that for you. You have an idea of the high level themes here, but the only way to know for sure is to kind of look at your details and then make some assumptions about the future. So hope that's helpful and have a great day. Please subscribe to this channel. It does not cost you anything to do that, and it lets you know when new videos like this come out. Plus, it helps me out a tiny bit, so thank you. And thanks to everybody who's already subscribed.